Hello traders, welcome to your Follow the Bots S&P 500 Daily Market Recap.
Hello traders, Bill Duryea here with Follow the Bots. Welcome to our daily trade strategy review. In this segment of our broadcast, we go over the trades that occurred during a given session. In this case, we're looking at the trades that developed during July 15th, 2013. The purpose of the trade strategy review is similar to what a professional athlete might do after a major game. Come back and look at what happened during the game time, analyze your performance, see what you did right, see where you can improve. We'll start today's review by taking a quick look at the longer-term developments in the S&P. Market structure is the key component behind the Gaussian model or the market profile model that we use to analyze the market. In Bayesian logic or market logic, the prior distribution, the previous trading range, tells us everything we know about the market at a given point in time. For example, at today's close at 1677, the S&P could do one or two things. It could auction higher, trade above today's high, rally up to the known high at 1685, or it could pull back off the high. Therefore, we cannot say with certainty what the next tick will be. However, the previous distribution points or indicates the price levels where specific expectations are more likely to occur than at some random point within the trading range. The current up move started with the last major pullback down to 1641. The key element of the current up move is that it broke out above a known high. This was not only the high on this given session, but there is a historic reference to this high that goes back to June 18th. Therefore, this high is considered to be a transition point. The market is in transition. It broke out above what had been a prior consolidation range and is now auctioning up into the next upper cluster of the trading range above it. Above this current high, there are other known resistance levels. The first one is here at 1670. The next resistance level is up at the multi-year high at or near 1685. During the rally to today's high, there are two additional support levels that have to be taken into consideration. First, Thursday's low at or near 1661. Second, Friday's low at or near 1666. In relation to today's high, this is considered minor support, and the reason for this classification is the distance between this low and today's high. On average, the S&P will trade in a 17 to 23 point trading range during a given session. An example of that is here, the low at 42, the high at 65. This is not an unusual state of market development. This is a more normal phase of market development. Narrow trading ranges, like we witnessed on Friday and during today's session, fall into the minimum trading range category. They are more typically associated with periods of consolidation where there is little genuine interest in the market. In other words, there are no substantive gains. The market may eke out a few points but then come back to the starting point of the day, pretty much end the session at or near neutral. That certainly was the case on Friday, when the S&P opened at the high and closed almost at the same price. However, during Sunday's Globex session, the S&P traded above Friday's close and ended the day by auctioning up to a new high. In this context, we'll take a look at the micro developments that occurred during today's session. If you attend our live broadcasts or have an opportunity to view them, you will note that every day I annotate on the chart the high that developed overnight, the overnight low and or the prior day's close to give a context to what has occurred during the overnight session. Now, many of our members are not active in the overnight session. The overnight session has proven to be a very good time to be an active trader. In the context of Friday's close, this move from the low at 1670 to the high at 1676 all occurred during Sunday's overnight session. Similarly, the pullback off of the high occurred during the overnight session. At the open of today's session, the S&P had auctioned back up at or near the overnight high. Price pulled back from 1676 and auctioned down at or near the minor low that developed during the overnight session. So in the context of today's open, the opportunity occurred here at number 4 to go short at the high, with the expectation that the market would pull back and potentially fill the gap at Friday's close. The gap between the high and Friday's close is very modest, and typically the market will pull back and fill the gap. In the context of today's session, the market failed to pull back to fill the gap and stalled on the pullback to 1672. During the pullback, if you look at the slope of the digital filters, you can see that a positive skew developed within this narrow range. This indicated that the market was likely to retest the high up at 1676. If you had not bought the low on the pullback, the second opportunity to get long was here when the S&P pulled back to 1673. If you missed the opportunity to get long on that pullback, the last chance was to buy the breakout at or near 1676. This is the trade that I posted in the Trade Status Monitor. I went long at this point, anticipating that the S&P would go on and make a higher high. Ultimately, the S&P did auction up to 1679. However, in evaluating my own performance, I wound up getting stopped out of the trade. The reason for my getting stopped out of the trade is that the market went flat here at the high. The time duration that it took for the market to auction up to the high did not occur until the close. I had initially bought the breakout at about 8:30, and the market pulled back almost at 11 o'clock and stopped me out. During that entire period of time, price traded in a range between 78 and 76. I'm not attempting with that statement to justify my getting stopped out or the way I managed the trade. I'm simply stating, honest and straightforward, the thoughts that were going through my head, and obviously they proved to be incorrect. I should have exercised more tolerance. The market traded up to my target at 78 2 times, but failed to fill the working order that I had sitting there for 2 points before eventually pulling back and stopping me out. The opportunity to be long during today's session was confirmed from the open to the close of the day by the events surfaced in the order flow monitor. It wasn't a strong day. There wasn't a great deal of conviction. but there was little or nothing in the way of initiated selling to encourage one to be an aggressive seller. On the other hand, the order flow events, including the activity that we see here in the MACD indicator, all supported trading on the buy side, confirming the expectation that the S&P would auction back above the opening range overnight high and extend the range above that price level. Technically, today is considered a higher high and a higher close. However, it should be noted that the gains relative to Friday's close are relatively limited, as is the trading range. The market is starting to show a lack of interest as trading volume has fallen off, the trading range has narrowed, and the rate of trade has become substantially below average. That concludes our trade strategy review for this Monday, July 15th. Thank you very much for joining us. It's a pleasure to have the opportunity to speak with you.
To learn more, take a tour of www.followthebots.com.